Hey guys, welcome to episode 2 of my podcast. I'm here at the Keller Williams Studio City Training Room, and today I want to talk to you about the home buying process. We'll do a series on this and then hopefully move on to some other things. But today I want to talk to you about home buying and the first steps of home buying. So today we're going to talk about 3 things. One is going to be your income to debt ratios, 3 things that actually qualify you for a mortgage. How does a mortgage broker affect you in getting the best rate and the best pricing, which gives you the most buying power? So the first thing that we're going to talk about is what we call income to debt ratios, because I tell my clients, listen, everybody qualifies for a loan. It really depends on how much income you make and how much debt you have. And that's the big aha moment for a lot of buyers, is they're realizing that their income and their debts aren't really in line with the guidelines for a home buying process. Those guidelines are typically what we call 28 over 36. So 28 over 36. What do I mean by 28 over 36? This is a customary guideline, and these guidelines can fluctuate depending on the type of loan that you get. For instance, an FHA loan may allow for a 38 over 45. So what do I mean by 28 over 36 or 38 over 45? 28% of your monthly income is what they're looking at to say should go to your PITI. PITI, which stands for Principal, Interest, Tax, and Insurance. This is what a bank looks at the total monthly payment and what it should represent to your income. And then the 36 is going to be the PITI plus any debt. Or even revolving debt. So that's going to look at your car payments, your student loans, credit card debt, and that means that those numbers have to stay within those numbers in order to be qualified. So what's that difference right there? That difference is about 8%. So when you look at bank guidelines, the bank guidelines are saying that roughly about 8% of your income can go to debt. And this is the coaching process that we get you in line for when getting you ready to home buy. A lot of times this is 18, 20% of your monthly income, and we work on a game plan to help you get that down to that number or less. Now, what if you're one of those people that only has maybe 1% in debt? I can move this ratio and scale you up to maybe a 35 over 36. So that way, you can have more going to a house payment and less going to your revolving debt. So these numbers can move differently. And then when we talk about an FHA loan, which is a government-insured loan, and we'll talk more about this in future episodes, but their guidelines are a lot more lenient. And you'll see a lot of lenders will offer you an FHA loan because these loans are more lenient. They will allow for non-occupant co-borrowers. They'll allow for shorter job stability. They will allow for lower FICO scores. So this program here will actually give you more buying power, but it's a little bit more expensive of a loan to get, and we'll talk about that as well. So the next thing we're going to talk about are the 3 things that qualify you for a loan. And I use this a lot in coaching my buyers as well. The 3 things that qualify you for a loan, and there's only 3 of them. That is your income, your credit, and your collateral. So the first 2 things we take care of in the buying process with the lender in the pre-qual is your income and your credit. The 3rd thing is the collateral. The collateral is the property. Is it worth the price that you're willing to pay for it? That's where an appraisal comes in. So there's only really the 2 things that you have to worry about, and that is your credit and your income. Does your income fall within that 28 over 36 guidelines? And is your credit score meet the minimum requirements for a paper type of loan? And that's probably going to be a FICO score of probably 720, maybe 680 and above will get you in those ranges as well. So credit, income, collateral. Those are the 3 things that are going to qualify everybody for a mortgage, and I need you guys to make sure you know that. So the last thing we're going to talk about today, and I'll probably just touch on this and we'll bring it up in future episodes, is how does your lender affect the buying process? A good lender can actually help give you more buying power, and that's important for you guys to understand. So what do I mean by that? I mean that every day interest rates come out. and 3.75, 3.875, 4.0, 4.125. Typically, rates come out in 8 increments. So a mortgage broker has the opportunity to give you a different rate based upon the pricing of today's rate. So let's say, for instance, today's rate is 0, or what we call par, meaning that, hey, Tom, if buyer A wants to take a loan at 4%, we're giving you that to the mortgage guy at 0% interest. But if he wants to take 3.875, Tom, we're actually charging you a half a point. And, well, if he takes 4 point, Tom, we'll actually give you a rebate of 1 point. So I think it's important for a mortgage broker to obviously make some money, but I want him to make money relative, and I want him to gouge my clients. So I look and I'll tell my buyers, I'll say, hey, always get a loan with a 0 points. So that way you don't have to spend as much money in closing costs that you would if you were going to spend money in points. If you're going to spend money in points, I want you to be able to recoup that money within 12 months. So to touch on this real brief, they come out with rates, the mortgage broker looks at the rates and determines how much money he's going to make off of you, and based upon that, he's going to price your loan out. So a good mortgage guy would say, hey, Tom, I'll give you 4.125, I'm going to make a 1 point rebate back from the bank, and I'm going to charge you 0 points, and that's a great loan. The challenge is if that guy then tries to charge you a point and then makes a point rebate, well, now he's kind of taken away from your buying power. So a good mortgage broker can actually pick a rate that will give you more buying power, and I think that's really important to maybe just kind of understand right now, and we'll talk about that in future episodes and stuff like that. So income to debt ratios, the 3 things that qualify you for a loan, and understanding to get a good mortgage broker that's going to really give you the best pricing that's out there. Hey guys, so thanks again for hanging out for episode number 2 of my podcast. I hope that information was good. Hang out for the next episodes. And again, if you need anything in real estate, I'd love to be the one-stop shopping place for you guys. Hey, thanks again, and we'll talk to you in a bit. Bye.